Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Wednesday edition of Trader Talk in today's market. I'm your host, Kevin Horner, joining you from a beautiful and seemingly fall Denver, Colorado. I am very pleased to be joined this morning by my friend, fellow Schwab coach, Ben Watson. Good morning, Ben. How are you doing today, buddy?
Good morning, Kevin. I'm well. Hey, we got a big rainstorm yesterday here in Utah, so it's probably headed your way. But yeah, it's nice this first morning of October this morning.
I like a little fall in the air, to be quite honest. Sweatshirt weather, some stews, some chilies, maybe some jambalaya, etc. You know, the stuff that I look forward to in the fall. I'm very, very pleased that we are on our way into Q4. Now, we did have some big news overnight, obviously. We've got a government shutdown implemented officially. We'll be talking a little bit about that, but take a minute this morning, everyone, and just take a breather to get us started. Say hi to our friend Barb Armstrong in the chat. She'll monitor, answer questions, get to comments that Ben and I are unable to get to, but nonetheless, we want to hear from you. Please feel free to post in there for the duration of our show. We'll go about 45 minutes in total here. And additionally, if you're not already doing so, a great way to engage with us coaches outside of the classes we offer you here on the YouTube channel is on X, and we're individually available there. So you can follow Barb Armstrong CS, Ben is Ben Watson CS, and I'm there as Kevin Horner CS. So we would really appreciate a follow there, everybody, and a great chance to get with us outside of what we do for you here every day. Now, we're going to jump right to disclosure so that we can get into the meat and potatoes of the conversation. So let's remember that our conversation here is exclusively informational and educational. We do not make recommendations nor endorsements here. Additionally, while we will discuss technical analysis, it's important to remember that technical analysis is merely a piece of your decision-making puzzle. We discourage you from basing your decisions exclusively off technical analysis. As far as an agenda is concerned, in this show, Trader Talk, which we offer you here 4 days a week, we will go through a top-down review of the market, meaning we'll start broadly. We'll hit up the S&P 500, we'll look at the NASDAQ 100, the Russell 2000, the semiconductor index as well, and then work our way through sectors on the move, and then additionally, stocks in the news today. So plenty to cover, as we always do here on Trader Talk. Now, Ben, as we started at the kickoff here, we've got a down open in the S&P 500 on the heels of this government shutdown coming to fruition. But, you know, Ben, there's been a lot of talk about how these shutdowns tend not to have the impact on the market that your average investor might expect it to have. Is that fair?
Yeah, I think that's fair. I mean, I think you could maybe make the argument that the temporary removal of maybe some of the impact of the government on business perhaps allows for greater business activity to take place. I don't know, just my perspective. Now, the thought process is, and I'm doing this, I'm going to be posting an X video a little bit later this morning talking about the impact of, say, for instance, the last 5 government shutdowns on the SPX, and it's really been nothing. Even the longest one, which was 35 days in 2018 into 2019, was really a significant lack of impact in the market. In fact, it spelled a turning point for the market moving higher. The SPX actually rallied off of that 35-day shutdown. Now, the thing to think about, though, Kevin, is if for some reason that government shutdown were to perpetuate beyond, say, for instance, that 35-day time frame, and the probability of that happening is relatively low. I mean, it's not zero for sure, but it is relatively low. Then you start seeing impacts to GDP. You start seeing impacts to, some of the other things that are just grinding to a halt, perhaps.
Sure.
In terms of permitting and stuff like that. But other than that, it just is a non-event when it comes to the market. It's a big event when it comes to news headlines, but it's a non-event when it comes to the market.
Yeah, that's kind of been the historical thought. Doesn't mean we might not see volatility in the short run on the heels of this announcement. And yet, I feel like, Ben, the other takeaway is that, when we've got a regulatory body that is constantly going back and forth on policy changes, policy shifts, the market would maybe take an event like this as a pause, and meaning no changes are implemented, which makes it easier to understand and expect market returns and market data. Now that we lock all that down, I think just the biggest difference is we haven't been going back and forth on policy. So there hasn't been, this won't be a lift, so to speak, to the idea that now we're not going to have any of those changes. So maybe more than anything else, we've just got a lack of information coming. And I think that might be the biggest hurdle we have here, because if we have got a government that has closed down, we're not going to be getting a lot of that data. That's the biggest concern on the forefront here, isn't it?
Yeah, absolutely. I mean, the impact of the day-to-day stuff, and given the fact that you and I are both traveling in the next couple of days, as is Barb, this is an area of concern. But, those essential areas, FAA, air traffic control, TSA, those types of things, national parks, at least at the moment, are all still in business, still working. But yeah, you're right. We're going to get a delay in the jobs report. We're going to get a delay in data that comes from the BLS and OBS and those types of government entities. So a lot of investors were kind of eagerly anticipating the fact that Friday we were going to have, theoretically, a jobs report, a non-farm payroll report. So now what we've got to do is we've got to rely on the private provider of that data, ADP, which is what has come out this morning and given us some insight. Now, there's always the question, right? Which is more accurate, ADP or the BLS, non-farm payroll report? And I would argue that they're probably both suffering from a bit of lack of veracity, perhaps, Kevin. What do you think?
Well, that's kind of always been the issue, hasn't it, Ben? A lack of veracity. I'll tell you, the trend of the market, if nothing else, and I should mention this, by the way, but let's do this. You mentioned we're traveling. I want to just highlight that so everybody's aware, because, you might be here for the first time. And when we say we're traveling, we just want you to know that means that we might be in an area where you could come and participate with us. This weekend we'll be out there in Chicago for one of our market drive events. We do these interspliced, so to speak, within our technical analysis and option strategies, or our advanced options workshops. These are a great way to come out and see what Schwab's all about, where we bring you out and we talk about the market from a 30,000-foot perspective. We introduce you to the other areas of the firm so that you know that you've got support in a multitude of factors and areas of the business here. These events are, of course, free to all of you. If you can come to one of these, we would love to have you participate. They are a blast. For those of you that have been there, I know many of you in the chat will say as much, but we would love to see you at one of these events. So please take a minute, take a look at the calendar, see if you have an opportunity to join us for one of these. The best way to do it, schwab.com/coaching, will bring you to our homepage here, and then you can navigate through the menus and find our on-demand or our live and in-person events. Now, Ben, as it relates to the S&P 500 here, real briefly, there has not been much of a shift in trend for quite a while. Now, we've talked about that lack of pullback for much of this last 4 to 5 months. But, the trend and the health of the trend hasn't given bearish traders a whole lot to work with here. In fact, bulls have been largely encouraged by the trend and the work at the 20-day moving average in orange, for example, to just keep going. Stay with your longs. There haven't been a lot of reasons for maybe even bringing defensive nature into the approach of the market here.
Okay, I agree with you, Kevin, with one small exception.
Cool.
Look at the high a week and a half ago, and look at the high yesterday, and compare those two highs with your line. There you go. What do you have? You have a lower high.
A little bit of a lower high.
Okay, now I get it, a little bit of a lower high, but a little bit of a lower high is still a lower high in the context. I know you talk a lot about Dow theory. You talk about the idea of higher highs and higher lows, lower highs and lower lows. In fact, that's how we teach the understanding of trend. But when you have a lower high, the next thing that you potentially start to look for, right, as a technically driven trader, is a lower low.
Sure.
We're not there yet by any means, and I'm not saying that we're going to get there, but we have a lower high at the moment, and that stands in place. You got to kind of think through this. If we were to see some kind of data impact or some kind of news impact come in and create a new low, that takes us below those recent lows that we've seen in the short term, then you have the potential for a short-term pullback, not a reversal, but a pullback. I would argue that we're probably in a little bit of a pause, coupling that with what you see on the RSI in your lower panel, Kevin, which is a little bit of a decline, a lower high in the RSI, not quite as much of a push to the upside here.
Yeah, we can always make note of these, Ben. And you know what I feel? The thing that I'm reminded of, Ben, is we've been talking about these divergences for months, sir. It's not like we haven't seen them. They've been there for a while, and yet we've not seen that pullback. So every time we talk about a bearish divergence from price, whether it be RSI or maybe alternate oscillators, it seems like these divergences are playing out in the form of trend pauses rather than trend reversals. We haven't seen any kind of bearishness lead, or any kind of bearish divergence lead to, from an index standpoint, lead to these pullbacks deeper than 3 to 4%. So haven't really been reversing. And while we could be as prepared as we want, really we probably need to lean with price action still. No?
Yeah, absolutely. I would agree with that. And I think, you know, all things considered, you're absolutely right, Kevin. I mean, think if you put this in the context, right? Draw the lower trend line, this lower high, maybe just a little bit of a pause until if and until we create a new lower low, and that'll happen at some point. I mean, we know that trends change. We know that trends don't always go up, despite our best efforts and best intentions and best wishes. So at some point, we're going to see a lower low.
Yeah.
But that day is not today, likely.
Yeah, it doesn't look like it at this point. But, you know, I'll give you one final note as it relates. This is more broadly than the S&P, as I'll navigate over to the NDX, and we're going to see a lot of similarities here, of course. But my reminder is that for traders, for those of you out there managing your positions day to day, week to week, just remember that if you're not feeling all as bullish maybe as you have been, you can be bearish without taking bearish positions. You know, we talk as trend traders frequently about the need to wait for confirmation. You trade the trend until the trend no longer works. And, you know, at certain instances, as Ben called out, we can get a little nervous when we get some of these bearish divergences, but you can be bearish just simply by building cash, right? Removing dollars from your long or bullish investments and just maybe being a little bit more in cash or focused on opportunity, right, Ben?
Or, Kevin, or you can do what it seems like a lot of investors are doing, which is pivoting to gold.
Yeah. Isn't that the truth?
You know, I've got to run. So Pat Mullally and I used to do on the Morning Huddle, we used to have an indicator called the Mr. T Gold Indicator. And what we would do is we would run a Google search for Mr. T. And if Mr. T popped up in the top 3 or the top 5 search results of Mr. T Gold, then we would say that gold was bullish, right? And that we were kind of in a gold bullish scenario, because that was at the time when Mr. T was out there actively buying back used gold, right? Sell me your used gold. He had a whole infomercial thing. So that was the Mr. T Gold Index. But I'll tell you what, you look at what's going on with gold here, and you kind of argue that maybe, number one, from the standpoint of kind of that uncertainty about the whole cryptocurrency space, the uncertainty about interest rate cuts, the uncertainty about government shutdowns and so forth, and that potential for rotation out of other spaces, gold is still continuing to see this rally here.
Yeah. You know, the structure, if nothing else, I mean, we could talk about it from a chart standpoint, just briefly, and highlight the fact that you've made a move through what many would consider significant resistance back there, Ben, at around that 3,500 or so. And all we've done since is trend upward against a speedy moving average like the 20-day. And we've seen that as well in silver. Silver having continued higher after breaking from a consolidation range. You know, remember, the reason I like to talk about this is because the theories associated with technical analysis still hold here as it relates to some of these futures. And again, really just thinking about it broadly, Ben, you've got
Yep.
Silver moving upward. You've got gold moving upward. It is likely tied as much as anything else, granted, to some of the fear associated with the broader markets. But then the dollar continues to fall here. And that's certainly having an impact on gold and silver, precious metals broadly, no?
Yeah, I would argue you're absolutely right. I mean, gold perhaps having more of or dollar having more of an impact perhaps on gold. Silver, I think, is kind of coming to the fruition this front because of its industrial uses and seeing, maybe again, I would argue there are probably two things going on. And again, remember, we're looking at these as measures of market movement, not as tradable instruments. I teach using these futures symbols as tradable instruments in my Trading Futures webcast on Tuesday mornings. In this instance, we're using them as a measure of what's going on the market. I would argue that perhaps there's more impact on silver from two purposes. One, industrial uses because of energy, and two, because it's cheaper, quite frankly, at the moment than gold. And it's still, to be fair, a precious metal. So I think there's still that storehouse of value idea.
So we have to keep all of these things in mind all the time, Ben. It's one of the reasons we offer the show, actually, is the ability to talk about this stuff daily, give consideration to these broader shifting trends, which we hope can give an underlying understanding of what the market is doing and maybe the why behind it here. So it's one of the reasons we talk this way on a day-to-day basis, Ben. I'm glad we get the chance to look at all of these various areas. We touched on the NASDAQ very briefly. I don't know that there's anything else that we need to say that we didn't say about the SPX already, which is long-term trend continuing, worked against the 20 and sometimes maybe the 50-day a little bit more consistently. But Ben, we see the same stuff nonetheless. Matching lows, not lower lows, pullbacks to horizontal support on breaks of the speedier trend. So like that 20-day moving average, maybe we find support at a horizontal level, create matching lows rather than lower lows, which again, you talked about the technical analysis 101 stuff, right? Do we have a lower low? And if we get a lower low, does that lower low lead to a lower high? And that by definition gives us a new potential downtrend, right?
Yeah, absolutely. I mean, the lower low without a lower high is simply expansion. A lower high without a lower low is simply contraction. And so you can look at it from that perspective in terms of it not being necessarily a trend change moment. So I think you got to kind of put it again in the perspective that it deserves.
All right. Now let's talk small caps. We have seen small caps get to a very important level, a level that could be considered a breakout. I'll say that based on the fact that we look at a weekly chart here, Ben, and you can see that we are at the top of a pretty healthy range here. We've been in this range dating back to late 2020, excuse me. So we are right at the top of it. This would be a fairly significant development if we could break small caps to the upside. So, Ben, with our movement in yields, which have been coming down, this has benefited small caps, but can they continue to push through? I mean, we are at an inflection point.
Okay, so I would argue one, from an interest rate perspective, yes. From a technical analysis perspective, yes. But I'm also going to make one other argument here, Kevin, the fact that if we go to the ADP employment numbers, and we look at what's happening in the employment situation, it's the small caps that are getting hit the hardest. So I've got the breakdown of the numbers here. So small establishments between 1 and 49 employees lost 40,000 jobs in this ADP number. Medium establishments, medium businesses, which also incorporates a fair number of small caps, 50 to 499 employees, lost another 20,000 jobs. So that's 60,000 jobs lost in that particular case in the small cap segment. That suggests that either they're seeing those impacts and they're not hiring or they're actively laying off. Large companies, 500 employees plus, added 33,000 jobs. So the employment impact, the cost impact, that's hitting the small caps. And I think that may be kind of the mitigating factor to the things that are perhaps benefiting the small caps, namely the fact that the 10-year has been on fall.
Yeah. It really has. You could certainly, traders, Ben, are probably going to keep an eye on that 20-day. I think it's fair to suggest that it's significant. I mean, we've been above it since back on August 11 here. That's the most recent push. Now that puts us with being on October 1. That's about a 7-week rally or so. So, we're getting to the long end here. This is an area that's clearly held support at the 20-day, and many traders would think maybe a pullback that broke the 20-day on a close might bring the 50-day. But again, that would still be an uptrend in the 50-day time frame. So we need to at least keep that in mind. If I was maybe drawing a line in, it might look something like that for potential support, right around 35 or so on small caps. Now, we are getting a little bit of a deeper pullback this morning in the semis. Semis had been on a bit of a tear themselves. If I'm not mistaken, more than 100+%. My line here will help me out, but how about, 86%? That's all. I got a little exuberant there, Ben, my fault. Off those April lows, the semi's up about 86+%. Really a fantastic move. Potentially in the midst of more consolidation here now that we've allowed the 20-day to catch up with that gap zone we found.
Yeah, absolutely. And I would argue that, again, this is pushed. I mean, we've seen some big, significant runs from early September. You saw a strong move up in the semiconductors, maybe a little bit of consolidation. Now we're testing the top of that range. And there is that potential for a breakout, but at the same time, it may consolidate look at the consolidation that this took from mid-June into September before it broke out. So sideways consolidation doesn't have to occur just over course of a couple of days. It can take a week or two or a month or two and then break out as that consolidation occurs.
Yeah, and I think the reminder once more, when we start talking concepts of technical analysis, the viewpoint of a technician here is you break these consolidations and you expect to trend thereafter rather than just going more sideways, right? You don't break it for one day and then go sideways. Commonly, they break out and start to trend upward against that speedy moving average. In this case, if I pulled the 20 off of here and went exclusively with the 10-day in the semis, you'll see how we've done exactly that, Ben. Broke through resistance, and now the 10-day, very speedy moving average for a lot of traders, became support along the way. You had a test here middle of last week where we got below it intraday, filled the gap, and then still managed to close above it. So that's really instructive, isn't it?
Yeah, for sure. Technical analysis would suggest that if you get that short excursion outside of a channel range or even out of a pattern that then comes right back in. And we saw that occur kind of early August in that previous consolidation where it made a one-day move out, tried to break out, and then rally, and then kind of came right back down. That's simply, I think, a confirmation of the strength of that consolidation, if that makes sense, right? The strength of those levels of support and resistance. And then once that consolidation is done, once whatever the concerns are on the part of those investors, then it pushes back up through that resistance level potentially.
And if I was going to throw one other piece in here, Ben, it would be the look at the RSI at the time that we were making those breakouts. You weren't getting validation. In fact, you were getting a bear divergence when we tried to break out last time. And so traders who were waiting for the breakout may have been saying things like, hey, I want confirmation in the form of price action. I want to see a new high that would then give the trader the belief that this was, in fact, breaking out. And RSI was kind of keeping you tamped down a little bit. If you were looking at RSI for confirmation on this move, you weren't getting it. So you may have had reason to be dubious about the potential to break. And then when you did break here, Ben, you can see that we actually, I'll remove that line now, we actually moved through and made a higher high there in the RSI at the time we broke out, giving traders some semblance of confirmation. So, we talk a lot about confirmation, Ben, because it's so important to the trader who wants to participate. You get confidence from confirmation, whether it be, something like the RSI or another oscillator of your choosing.
Sure. Hey, there's one other thing, though, Kevin, it's important to point out, the fact that the SOX here, this is an index. And as such, this is not a tradable instrument. Right. But its components are tradable. So to be fair, this does not behave with those same kind of impacts of a tradable instrument having levels of support and resistance and individual buying pressures at those levels. This is reacting to what's going on with the components of this particular index.
Yes.
And that's an important distinction. Because even if we were talking, okay, and so I'm going to disclaim this really, really quickly. So please listen to this disclaimer. We're not going to talk about an ETF, but I want to describe an ETF in its mechanism so that you can see the difference here. So if you're going to trade an ETF, make sure that you read the prospectus and you understand the characteristics, risks, charges, and expenses of whatever product it is that you are trading. An ETF, which is a basket of individual components that trades with its own pressures, but reflects the pricing of the individual components, is a little bit different than an index because the ETF trades itself. That's the name of the product, exchange traded fund. So it's got its own pressures, and ETFs will trade at a discount to or a premium to the net asset value of the basket of its components. An index doesn't do that because the index itself does not trade. Some indexes trade options. And in fact, I teach that. I'm coming up next at 11 a.m. Eastern time with my Trading Index Options webcast. And we talk about this. But this index is a little bit different. So what you're seeing here is the net effect of the components of this index driving above or below these particular levels. And it's also going to be a function of the weighting of this particular index, Kevin.
Mm-hmm. It absolutely.
Sorry, that was a quick soapbox there, but
No,
I apologize.
There's not much more that I enjoy than Ben on a soapbox, and thankfully I get to see it frequently. So I appreciate it, Ben. Yeah,
sure.
We definitely encourage our viewers to know. In fact, it's a very important aspect, by the way, to know the makeups and components of those investments. So make sure you're doing your due diligence, dig into the component breakdown, your holdings, etc. Very, very important. We touched on the Russell. We didn't look at yields. Let's just do that real briefly. You can see we are pulling back yet again, Ben. If I was looking at this from a technician standpoint, as I often do, sure looks like a test and rejection at the 50-day former resistance, or rather former support, now potential resistance. And many traders would tell you, Ben, now that you've been to that ledge and you've now traded below the low of the day we made our high in that rally back, that we might be just looking at a return to the levels we've previously seen. Is it maybe speaking to 4% here?
For sure. And then that speaks to the fact that, hey, we've got the potential, at least on the part of the Fed, as what they've told us, for one more, maybe two more rate cuts by the end of the year. And so if the market's doing that on their own, here's always the conundrum. Because if the market's cutting rates on their own, remember the Fed only has impact on the front end of the curve, the very front end, the overnight rate. In terms of changing that target, everything else is a trickle through. This may be the trickle through from the September rate cut. But if this starts pushing down, that's going to bring the front end down, and that may do the work for the Fed, and they may not cut.
Yeah.
And we couple that with the overall impact of not having data or data delayed.
Yeah.
Kevin, it's a mess.
I think that's the reminder. It is a mess. We really don't know what's coming. We are going to be lacking information, and that could be problematic. So if nothing else, Ben, it's important that investors and traders alike be invested to their comfort. I think that might be the best way of putting it, because the truth is, while we have history on our side, we do know, as we talked earlier about historically, government shutdowns not having a dramatic impact on the broader trend of the overall markets. Nonetheless, that doesn't mean things couldn't get uncomfortable. It definitely bears watching. One thing we do know, Ben, is that when the market thinks that we're getting rate cuts and then suddenly we're not thinking we're getting rate cuts, the market doesn't like that change of mentality, does it?
It does not. The market doesn't. Look, the market can handle uncertainty. It just doesn't like uncertainty in a short time frame. It likes it in a particularly defined longer term time frame, and uncertainty can be dealt with. And that's why I think we're seeing the VIX a little bit higher. I mean, 2.95, even though it's down on the day, it opened higher. So we're seeing a little bit of volatility bleeding in here. And I think that's kind of the impact to what we're seeing, this swirling miasma of Are we going to get data? Are we not going to get data? Are we going to get a cut? Are we not going to get a cut? What's going on with gold? What's going on with equities? And so I think that's kind of where we are.
Yeah,
Welcome to October.
Healthy reminder that a market needs worry to climb bullishly, Ben. We say it all the time. Bull markets climb a wall of worry. To suggest we don't have worry in this market would be kind of a silly comment, so I won't say that. But the market's been giving us opportunity nonetheless, and maybe we just want to fall back on broader trends. But as always, invest to your comfort, know where you stand. Ben, we have some leadership from a sector standpoint back in healthcare for the first time in a while. Healthcare might be breaking out, sir. We've been, I should say we, but all of us here on the show, and Trader Talk in particular, I've been talking about the improvement to this space for a while, sir. And we've bounced real well off of horizontal support, 50-day moving average in the last 3 to 4 sessions here, making a potential breakout through not just the 200-day moving average in blue, Ben, but a very healthy, lengthy downtrend in this space. I can kick this to a 2-year time frame, and you'll see that this is an important level to get through. So, one, we like what we've gotten here from a healthcare sector standpoint. But I got to point out that, as a reminder, every sector has industry groups within it, and there are going to be leaders and there are going to be laggers. Well, here, interestingly,
I was going to say, do you have pharmaceuticals in there?
I'm going to show you biotech, sir, and this is why. Take a look at this phenomenal breakout today on biotech. Excellent consolidation in the short run, right against horizontals or against support along the 50-day moving average. And then here in the last day or two, now you've busted it to the upside. So always be reminded that each sector has industry and sub-industry groups that could be providing leadership. And maybe, Ben, we want to be leader traders, right? Groups trading in groups where, as you like to say, you want to be a small fish in a big pond of participation.
Absolutely. I think, if you've got leadership within the sector, you've got leadership within a sub-industry group, and then you can find the leading stocks within that industry. Now you have individual opportunities. The cool thing, though, too, is, with trading indexes, you have some of those opportunities to trade not only the individuals within the space, but in some cases, the indexes themselves, or the sector indexes, or the sectors. And to be fair, there are other products that you can use to trade kind of that consolidation or those larger conglomerations of products. But Kevin, take a look at Pfizer, PFE, in the context of this, because I think that's where we're seeing, certainly a lot of the strength, and you see some similarities there in terms of what it looks like to what the overall healthcare sector is doing and what that biotech and the pharmaceutical space is doing as well.
You're absolutely right. Yet again, a reminder of why we do this stuff, why we pay attention on a day-to-day basis, because you can get some heads up when you start moving through various and important levels here. I mean, this looks like a range break on Pfizer, Ben, that had been in a bit of a consolidation. Notice how all those moving averages are kind of come together here over the last few weeks. So busting out of a potential range, call it, say, 23.5 to 26. That's an interesting move on Pfizer. That's a stock that's just been struggling for a very long time, Ben. It really is struggled to get itself in gear here, but maybe 27 presents a little bit of short run resistance here based on prior range, prior channel there. Interesting stuff.
One other thing, Kevin, I want to want to rotate to really quick is I'm going to go back to the ADP report, because I've got the breakdown here in terms of where jobs have been added. And healthcare services up 4.4% in terms of job adds since the last ADP report, as well as professional business services, which also encompasses kind of the professional side of healthcare. So that's up 4.2%. So you're starting to see healthcare jobs being added. Where you're not seeing those ads happening really is in some of the goods producing. So construction is down a little bit, manufacturing down just a little bit, but natural resources and mining up 4.3% here in this particular case too.
Oh, we should do that. Before we do, you asked for pharma, and so I'm just going to put up the look quickly here at the pharma, which is also giving you a breakout move, fairly significant one. Once again, we'll see if the downtrend line plays into this at all, but it certainly could. I mean, we're right there, so we should at least be aware of it. So that's a notable maneuver there. Ben, there was let's see. I had a thought a second ago, and it completely escaped me. That I don't know. Does that happen to you anymore, Ben? I mean,
Well, I was just going to say I'm going to relate that to the fact that there's a reason why healthcare is probably adding jobs, because we have an aging population and our birth rate is down. So, as we become older, you and I both. Now, Barb's becoming bionic. She's added both,
right.
new knees. So she's addressing that. But you and I, Kev, the gray is starting to get in there, and we think about October and the little snow on the top there, and
Yeah,
we're getting older, my friend.
maybe a little more snow than most in some of our cases. So, okay, healthcare moving a little bit today. You're getting utilities on the move today as well, because you're seeing yields fall. So my thought would be, as yields continue to pull back, traders are taking a little bit more confidence in building into utilities. They'll be happy to take the market risk associated with utilities for that improved yield, which is where some traders might find themselves. So this doesn't look terrible, Ben. As an old friend of mine used to say, my guy Lee Bull would tell us, new highs are typically not bearish, and you have utilities at new highs here today. So continuation move is what it looks like in many scenarios here, Ben. Wow.
Yeah, absolutely. Look at that.
Look at that.
I mean,
that's a weekly look at the utility space.
But Kevin, you gotta think about the power draws. I mean, we talked about this in our last market drive in Dallas. We talked about the fact that the power infrastructure, electrical infrastructure, which falls within the utility space, they have a knock-on benefit of the fact that the interest rates are going down, which benefits utilities in general, because they generally have to bond for equipment and infrastructure construction. So they're doing it at a lower rate, their debt service is lower, and there's enormous demand for electrical utility infrastructure build out at the moment, because of AI, because of cryptocurrency demands, that build out, and plus the fact that we ignored our electrical infrastructure for the better part of 60 years.
No kidding.
So, we gotta build that out.
Yeah. It's a good reminder. That's why you've seen, among other reasons, that's one of the reasons behind the push in utilities has been tied directly to AI needs for power and so forth. So a real fantastic move. I mean, again, off these lows in April, this is a space that's done exceptionally well. You don't generally get utilities moving 20+% in a 6-month period, Ben. That's very uncommon. But it bears watching, because one thing that we do know is that they being these AI companies, are spending. So that's because they need this power, among other things. So
and believe it if you want or not. I mean, believe in AI or not. Yeah. This is the boots on the ground, if you will, of the reality of the situation, that they're spending that money and this is happening and the construction is happening. So
that's true.
There you go.
Okay, a couple of points. Number one, I saw we had a survey make the chat. Everybody, if you haven't, we greatly appreciate feedback in this show. We take that feedback directly. It comes to us directly. So you can give a score, you can give comments. Comments are always appreciated. If you're going to take the time to make a comment, we're going to take the time to read it, especially if that comes with some semblance of ideas that you'd like to see us bring to these particular shows. That would be helpful. So if you click that link in the chat, what's going to happen, it'll open up a browser window right next to this one. You can get to it post-show. Let us wrap things up for you, and then just tell us what you thought about the segment. That would be so helpful to us, and give you an opportunity to let us know what else you'd like to see in this show. So take that for us if you don't mind. Now, Ben, the other area that I've noted has been doing exceptionally well with rates dropping has been the home builder space. And I thought we could peek in on that with yields coming down yet again. And the trend, when you look at yields falling and an area of support in home construction, this could also be an area where bulls are kind of looking.
Yes, you're absolutely right. And I think you're seeing that bounce here. And then I'm going to pivot back to where we're seeing kind of that job not growth or job loss. And that's coming in the home construction space, which is interesting in the fact that you're seeing that decline. Now, there may be other political reasons for that, right? And I'm not going to get into that. But given the fact that there's what seems to be increasing demand for inventory within the home builder space, you're starting to see the home builder stocks picking themselves back up a little bit and starting to move a little bit higher. So that's doesn't necessarily bode well, perhaps, for home prices when you see maybe longer lead times, but you see more demand, which is coming into the home builders.
Mhm.
That creates a little bit of a conundrum, and we're not there yet. But I think that maybe is the over the horizon problem here, because you have higher construction costs.
Sure. And that makes perfect sense. But, one of the things that I'm always brought back to here, and when I look at this chart, Ben, is we've been talking about the struggle associated with housing and maybe the shortfall of inventory, at least inventory at prices where buyers are ready to act, maybe tied directly to yields and rates, et cetera. But Ben, this group has been improving for a while. And if you've missed, you may have been not paying attention because you're listening to the narrative going on around you instead of watching what's happening in the market. And the market is always forerunning us, right? It's always out in front about 6 months, maybe 9 months, maybe even a year on broader trends. So that you can
I would agree with that.
by paying attention to this stuff in advance, right?
Yeah. And here's the other thing too. The way that you take this out, and I talked about this yesterday when I was teaching long options. You do the left thumb test, and some of you have been in the live events when I've done this. You just take your hand, your left hand. It doesn't have to be your left hand. You can be right-handed too. But you take that and you put it over the top edge of your computer screen, and it's only because the symbol is on the upper left-hand edge of the screen. You put that thumb over that symbol on the chart. You can kind of see where my thumb is. You take out the narrative and you just look at the technicals.
Mm-hmm. I like the sound.
There you go.
That can be helpful,
It
right?
solves part of the problem. Yeah.
Yeah. Look left, confirm right, cover up that symbol. Let's just pay attention to the trend, make things a little easier on ourselves. All right. Ben,
For sure.
Boy, my goodness, we are right just about at time. That went fast.
I know it
did,
didn't
a couple of things in the chart. Rather in the form of news here, there was a downgrade in a company that has been doing pretty well in terms of the recent rallies. Marvell has done fantastic coming off of its lows here from April, around 48 up to 82. It's been a wonderful push. They got downgraded at TD Cowen to hold from buy, new price target of 85. It's actually down from 90. Now, Ben, what stood out was, again, the move we've made and the area to which we have rallied. I'm wondering if maybe this is a technical downgrade as much as anything else.
I would argue that that's a test of what is perhaps becoming kind of a lumpy cup and handle type of pattern.
Okay.
And, bailing out from that. I mean, it's not at all unusual to see prices fall from a resistance level that's been tested multiple times, especially when it's coming at the edge of a gap, when it's coming as kind of a big breakout, kind of coming as the midpoint of a big downward push. This can certainly, where you've got that dashed line drawn, Kevin, is a major level of support and resistance from both directions.
Yeah. That's crazy. I didn't realize. I'm glad I drew that in because I wasn't expecting it. But we are basically right at the same one. It was resistance. Then it became support for a brief second, very brief, before a earnings gap lower. And now that we've been, we were there just a few months ago, weren't we?
Yep.
And pulled back from it. Whoops.
There you go.
Yeah, there's been all kinds of action at that level, Ben. So I think it's a healthy reminder of, once more, you can incorporate very standard technical analysis to your view and probably be relatively okay. You don't have to get cute with your analysis, do you?
Yeah, you don't. And it's just a matter of looking left. Like you said, you borrowed my phrase, look left to confirm right. And you can kind of see where those levels are. And, you don't have to be precise about it. Just draw where the lines make sense.
Yeah, exactly that. And you know what they say, Ben? You steal something like that, it's an homage, And
Right.
The next time I use it, it'll become mine. That's okay. We share all of our idioms and axioms together. That's the whole plan. So one more, maybe. Let's see here. Okay, so there was an upgrade for Delta. And the one thing that stood out on the upgrade was the fact that Delta hasn't moved favorably on it. I mean, we're up third of a percent. Jefferies upgraded Delta to buy from hold, put a target at 70 from 62. The space here has been doing better, but this has been under a little bit of a brief pullback, whether it's Delta or the airlines specifically. The whole group did really well, but now we're in the midst of a pullback. I found the upgrade to be notable, but when I'm looking at the entirety of that space, it's not exactly as strong as it once was. Now that we've broken,
it is not, and it's broken that diagonal downtrend or uptrend line, and I think that's a point of concern. Delta can get an upgrade, but I'm still like 27th out of 35 on the upgrade list for first class for my trip to Chicago tomorrow. I'm just saying there's no fairness there. That's just, I don't know. Anyway.
For someone who travels as much as you do, Ben, I support this idea that you should be a little higher on the upgrade list.
It's the problem of traveling out of a major Delta hub when everybody has credit cards and those of us that travel for a living, we kind of end up in the back of the line there.
Yes, you do. Yes, you do. Well, Ben,
anyway, that being said,
a wonderful discussion. I'm so glad to have you here. Thanks for helping. Thanks for chatting with all of our viewers and attendees today. It looks like we had a healthy number of attendees, and I certainly enjoy getting to chat with you, as we often do on these in-person events nowadays. So make sure everybody gets a chance to come out and visit us, y'all. So check us out. Schwab.com/coaching is the place to go for all that we do here on a day-to-day basis, as well as the in-person events. Follow us on X, Barb Armstrong CS, Ben Watson CS, Kevin Horner CS. If you liked our discussion today, we'd greatly appreciate a hit of that thumbs up button down below. That'll help us out when we get this into the archive, and it will be in the archive within a couple of hours. So you can use the archive list and just keep an eye on that, bookmark it. This one will be right at the top very shortly. So again, thanks to Barb, big thanks to you, Ben. Thanks to all of you for being here. We always appreciate hearing from you in the chat and participating. It's a big help to us. And don't forget to take that survey. We'd love to hear from you there as well. So we hope you have a great rest of your Wednesday, everyone. We look forward to catching up with you again real soon.